In this video we are going to talk about 8 ways rich people avoid paying taxes. So before starting, please like this video and subscribe to this channel for our future updates. So, the more you earn, the more taxes you pay. No way. While US tax policy is designed to penalize high earners, the ultra-rich frequently take advantage of regulations that reduce their effective tax rate. According to Ron Carson, founder and CEO of Carson Group and co-author of Avalanche, the 9 principles for uncovering true wealth, America's wealthy are different when it comes to tax planning because they can categorize their assets. Their net worth often presents opportunities for tax planning, he added. Tax avoidance by the wealthy is nothing new, but there has recently been a push to make them pay more. Senator Elizabeth Warren of Massachusetts, who announced her 2020 presidential bid earlier this month, proposes a 2% annual tax on households worth $50 million or more, and a 3% annual tax on households worth $1 billion or more. Representative Alexandria Ocasio-Cortez, D. New York, proposes a tax rate of 70% on income over $10 million. And Vermont Independent Senator Bernie Sanders favors a tax increase. So, if you want to lower your taxes like the wealthy, you need to consult a financial advisor or CPA. Explore dividing your assets into 3 tax regions: taxable, tax-deferred, and tax-free, said Carson, a CNBC Advisor Council member. While the wealthy have many ingenious ways to reduce their taxes, here are 5 of the most prevalent. Number 8. Income from wealth and income from work are taxed differently. Most working Americans are hourly or salaried. Taxes are normally deducted automatically in both circumstances. For example, high net worth individuals often earn money from stock holdings, property, or other investments. A lot of things happen to help them: their stock portfolio and art collection, and the real estate market moves in their favor. According to Huang, this revenue is only taxed if sold. Unlike ordinary wage workers who pay income taxes in real time, very affluent people can opt not to pay wealth growth taxes. Individuals or married couples earning $523,600 or more pay a maximum tax rate of 37%. Wealthy business owners often underpay themselves to avoid paying the higher tax rate. As CEO of Amazon, Bezos received barely $80,000. Steve Jobs, Meg Whitman, Larry Page, Sergey Brin, and Mark Zuckerberg accepted $1 per year in remuneration from Apple. Number 7. Wealth can be translated into spending money without being taxed. How is wealth income utilized to buy something if it works and is taxed differently from work income? How does an asset become spendable cash? That rich people typically rely on loans. Instead of selling their stocks or real estate and using the revenues to sustain their lifestyles, many of these people borrow money, Huang continues. Huang claims banks are more inclined to give wealthy people large loans with low interest rates. According to Business Insider, billionaire investor Larry Ellison secured a $9.7 billion line of credit in 2014 using stock shares. Last year, the publication said that Musk used Tesla stock to secure a $550 million loan. Borrowed money isn't taxable because it's not considered income. A bank considers someone with a few $1 billion in stocks, or even a few million, as very low risk, Huang explains. So, they may fund their lifestyles and enjoy the wealth without paying taxes. Number 6. Rich people hire lobbyists and lawyers devoted to keeping their taxes low. High net worth individuals frequently use their wealth to hire consultants, make legislative donations, and invest in policies that keep taxes low and wealth expanding unrestrainedly. Tax lobbyists for the country's wealthiest people and corporations enable and maintain direct connections between affluent people's economic interests and lawmakers, essentially ensuring their presence on Capitol Hill. Tax policy is one of the top 3 most pushed issues in Congress, Huang tells Teen Vogue. Also, wealthy people hire tax lawyers who know the tax rules and can find ways to legally save their clients money when they file their taxes. Unlike most Americans, affluent people may shape laws by having their voices heard at every stage of the lawmaking process, Huang adds. They have armies of lawyers, accountants, and lobbyists who can help them challenge the IRS in court. An audit by the IRS is a rare occurrence that permits the wealthiest Americans to fraudulently avoid paying an estimated $175 billion in taxes each year. Due to years of recurrent budget cuts, the IRS rarely has the workforce or internal resources to conduct costly audits to make large firms and wealthy individuals pay their taxes and penalties. Huang says that the missing billions are needed right now to pay for important national program and important infrastructure projects that need to be done. Number 5. Charitable donations. Giving money to charities has traditionally been a strategy for wealthy people to reduce their taxes. The new tax code also increased the deduction to 60% of your AGI from 50%. Create conservation easements, says Feathergill, who is also the national head of legacy and wealth planning at Abbott Downing in Winston-Salem, North Carolina. Land has intrinsic worth. Perhaps it's a bird migration field, a riverbank, or some green spot in an overdeveloped area, she said. You may often work with land conservation trusts and deduct the value of the conservation easement you put on the property. Of course, the regular taxpayer can deduct charitable contributions as well, but the bar is higher. They must itemize their taxes to do so. The Tax Cuts and Jobs Act more than quadrupled the standard deduction to $12,000 for individuals and $24,000 for married couples who file jointly in 2018. This was a big increase. Number 4. Increasing equity exposure, managing gains. Wealthy people choose stocks because, if held for a year, the tax rate is lower than on wage income. They can also afford to risk more. Many with higher net worth also have higher risk tolerance preferences and risk capacity, Carson added. For 2018, the long-term capital gains tax rates are 0, 15%, and 20%. The federal wage tax brackets range from 10% to 37%. A year's worth of short-term capital gains taxes is linked to your federal tax bracket. Feathergill noted that the wealthy also look to handle capital gains and loss taxes efficiently. For example, near the end of the year, people aim to incur losses to offset profits made earlier in the year. She also sees people investing in low-income communities to defer capital gains. Anyone, not just the wealthy, can do it. If the gain is large enough, they can look for ways to defer tax, she said. Number 3. Managing assets like a business. Creating a structure such as a limited liability corporation, or LLC, to manage numerous investments is one approach to saving on taxes, according to Feathergill. It could be a collection of assets, real estate, or a company. While it may be complicated, she highlighted that there may be ways to save money, while also establishing a governance framework for your assets. If the LLC is a management company that looks after and advises the owners of assets, some of the LLC's expenses can be written off as business expenses. Number 2. Estate and gift exemptions. Gift and estate tax deductions assist reduce taxable income, but now there's more motivation to use them. The new tax law temporarily doubled the deductions. Individuals can now claim up to $11.18 million, versus $5.29 million in 2017. The exemption ends in 2025, so the wealthy are taking advantage. Many of them are creating long-term trusts like the Delaware Dynasty Trust, she said. While it is subject to income taxes along the way, it is not subject to gift taxes, and is not subject to estate taxes when it is withdrawn. Feathergill says that due to the expenditures involved in setting up and administering a multi-generational trust, only $5 million or more is required. Number 1. Defined benefit plan. A defined benefit plan, like an old-fashioned pension, allows business owners to save a lot for retirement. For an individual owner, that can represent well over $200,000 a year, Carson says. There are many ways for high-net-worth individuals who manage successful businesses to save tax-free money beyond what a 401k allows. The new tax law's limitations on the 20% qualifying business income deduction appeal to the wealthy. The QBI cap is $157,500 for singles and $315,000 for married couples filing jointly. The payment to a defined benefit plan will assist in reducing the individual's taxable income, Carson said. It can also bring them below the criteria for the 20% deduction. But defined benefit plans aren't for everyone. You must determine if it meets your retirement and business needs, Carson added. Make sure it meets your retirement savings and company needs, he advised. For others, a SEP, simple, or 401k may be a more cost-effective option to save and reduce taxes. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.